Everyone is piling into AI stocks right now, and there's a pretty good darn reason why. The gains have been incredible because the growth has been incredible. But no doubt you've heard the adage, what goes up must come down. So if you're heavily invested in this niche, then it's worth considering. What happens to my portfolio if the AI bubble pops? The internet bubble proved that party can't last forever, and it's those people clinging on to the glory of the past that pay the stiffest price as things implode. That's why today I'm going to show you 4 stocks that don't care what happens to AI. Several were compounding gains before ChatGPT was even a twinkle in anyone's eyes. And they'll keep compounding long after the next AI darling comes and goes. Be sure to stick around to the end because you'll never see that last one coming, but you'll love where it's going. By the way, I'm Steve Reitmeister, but all my friends call me Wright. I spent nearly 20 years the editor-in-chief of Zacks.com, and today I'm a partner at WallStreetZen, where our quant rating system analyzes thousands of stocks through 115 different factors to find the ones most likely to beat the market. So if you like the idea of owning stocks that win whether AI booms or busts, then hit that like button. Tells the YouTube to push more videos like this one straight to your feed instead of the usual hype and speculation. Now, first, a little background on why the smartest money is quietly bracing for trouble and why you should be cautious as well. Right now, a handful of giant tech companies are now spending somewhere north of $700 billion a year on AI. That's an enormous bet on demand that hasn't fully shown up yet in the results. If that demand comes in slower than promised, then spending will come down hard. And look at how that money is moving right now. A lot of the AI deals are circular in nature. The chip makers invest the startups. The startups turn around and buy the chips, and the same dollars get counted more than once. That's the kind of thing that could look brilliant on the way up and really, really ugly on the way back down. On top of that, the money has crowded into a tiny number of stocks. The minute the story wobbles, everyone heads for the same exit at the same time, which often leads to a plummeting share price. All right, I'm not telling you AI is a fad. It most certainly is not. But valuations in certain parts of this market are getting quite stretched, and that can spell trouble if the growth story changes and slows down even just a little bit. When that happens, the best move isn't to guess the exact top, it's to already own businesses that keep compounding no matter what the AI headlines say. That's what these 4 stocks do that I'm highlighting with you today. Now, quick note before we dive in, everything here is for education purposes, not personalized investment advice. All investing carries risks, so do your own homework before buying or selling any stock. All right, first up, we have Eli Lilly with a symbol of LLY. This is a name you already know, and it has a story that is completely detached from the AI revolution. They're sitting on the biggest weight loss drug story in history. Their GLP-1 medicines, the same class as Ozempic, are enjoying massive demand, and that demand keeps climbing whether or not a single new data center ever gets built. And here's the part that makes this durable. Demand is still running ahead of what the whole industry can produce. Lilly is pouring billions into new manufacturing just to play catch up. And these drugs keep finding new uses. They're already approved to treat sleep apnea, and they're being studied for heart-related conditions too. That means there's a lot more upside to their growth runway. And yes, the excitement of that growth story is already showing up in their numbers. Now, remember, Lilly is already a $1 trillion market cap company, and yet they are sprinting ahead like some kind of small cap biotech. We're talking about likely 30% revenue increase in 2026, translating to 50% earnings growth. Now, Wall Street is quite bullish on these shares, which shows up in 11 strong buy recommendations, and price targets still are well above current levels. Now let's look at what the Zen ratings have to say about Lilly. Overall, they earn a coveted A grade equal to a strong buy recommendation. In fact, they rank in the top 3% of every stock we track for its fundamental profile. That overall grade is built upon 7 component grades, each ranking the stock against the entire 4,600 stocks in the database, helping to show the strengths and weaknesses of every company. Now, Lilly ranks highly in several areas, starting with the top 25% for growth, and we have top 16% for value, top 14% for momentum, but the strongest grades are for sentiment and financials, both in the top 12% of all stocks we track. This combination tells you exactly what you would expect, that Lilly is a high-quality compounder the market trusts, with healthy finances and growth prospects. The most surprising part is the strong score for value. Add all this fundamental goodness up, and you understand why Lilly is the #1 ranked stock in the entire general drug manufacturing industry. Here's the honest risk. This is a surprisingly volatile stock given its size. That's because every new competitive drug announced in the industry has sway on Lilly and their peers. But Lilly is clearly the top operator in the group, which increases the odds that they will get their fair share of the massive demand over time. That makes it the type of portfolio anchoring business that could prove beneficial whether the hot AI trade finally cools off. And by the way, if you want to see how I put this kind of analysis to work in real time, then you might be interested in my free weekly live training sessions every Monday evening. That is when I talk about timing market events and my top stocks that I'm watching right now. You can sign up for free free at WallStreetZen.com/live. Okay, back to our stock picks. The next ticker is about as far away from AI as you can get, and it happens to be one of the highest rated names in our entire database right now. That brings us to HF Sinclair with a symbol of DINO. The company runs oil refineries that move the entire economy. No algorithm or chatbot is going to disrupt that business. And here's what really protects this business. Guess how many major new refineries America has built in the last 50 years? Zero. Not a single one. And the next one coming online took a foreign partner and billions of dollars just to get it off the drawing room floor, and it likely won't refine a single barrel for years to come. That's how hard this is. The permitting is brutal, the costs are enormous, and the regulatory fight can drag on for years and years. So the refineries are already standing, like the ones from Sinclair, sit behind a wall almost nobody can climb over. It's an economic moat made of red tape. On top of that, the company has experienced a serious turnaround. Refining margins fell apart through 2024, and the stock got punished for it. But that business has swung back with impressive profitability, and the stock has followed suit. Now, Wall Street is actually split on this stock. A handful of analysts love it, including a top-ranked name at UBS with a strong buy recommendation, but plenty are still sitting on the fence with a hold rating. And honestly, that's part of what makes it interesting, because as the earnings momentum continues, more analysts will flip from hold to buy, helping to push shares higher. As we turn to the Zen ratings, it is a unanimous bullish review, leading to an elite A rating that points to shares that usually outperform the market by nearly 3 to 1. That A rating comes from being the top 1% of every stock tracked for its stellar fundamental profile. More about that in a moment. By the way, the Zen ratings are updated every day, right? So it's a good habit to go to the quote pages on WallStreetZen.com to look up the current ratings for this stock or any other you're interested in. Now let's focus on the component grades for Dino, which are amazingly strong. Top 8% for financial strength. Top 4% of all stocks for our proprietary AI factor, which spots early patterns of outperformance. Top 2% for growth and top 1% for value. Elite grades for growth, value, and timeliness. Who could ask for anything more, right? Note that the refining industry overall scores an A rating from our industry rank. And Dino is the highest rated stock in the group. Always a good idea to go for the top stock in a top industry. The risk here is that refining is a cyclical business. Right now, it's on a major upswing, but any signs of tipping over to a weaker cycle, and the stock will no doubt plummet. All right. Bottom line skews to a very bullish outlook for this stock. Not only do we get an elite Zen rating scores for growth, value, and timeliness, but we also get an appealing 3% dividend yield that they are likely to increase in the future. For a business AI literally cannot touch, Dino is a hard one to ignore. Quick ask, if you're getting value from this stock review so far, then please hit subscribe and turn on the notification bell. That's because I publish data-driven analysis like this every week, and this is the best way to ensure you don't miss my next stock recommendations. Now, the next one is the literal backbone of everything America is trying to build right now. I'm talking about the steel industry giant in Nucor with a symbol of NUE. Reshoring factories, rebuilding infrastructure, and yes, even constructing those giant AI data centers, all of it includes a massive amount of steel. And here's what separates Nucor from the competition. Most of the world still makes steel in the old-fashioned way. Massive, aging blast furnaces that burn through enormous costs. On the other hand, Nucor runs mini mills that melt down recycled scrap in electric arc furnaces. They're cheaper to run, faster to flex up and down with demand, and far less wasteful. That cost advantage is structural and lasting. In fact, it actually gets wider in a downturn because when prices fall, it's those high-cost producers who struggle the most. The edge has made Nucor the low-cost king of American steel for years. Every time a competitor struggles, Nucor takes a little bit more of the market. That's exactly the kind of widening moat you want to own a piece of. Now, on the Wall Street side of things, this stock is a consensus buy, and top-rated analysts have issued a slew of strong buy recommendations in the past 2 months. Right now, several major firms are recommending shares to their investors, including Wells Fargo, JP Morgan, Barclays, and Citigroup. Their impressive fundamental prowess shows up in spades in the Zen Ratings Quant Review as well. Remember that our A rating applies to all stocks in the top 5% of the 115 factor analysis. However, Nucor is truly cream of the crop in the top 1% of all stock. Once again, we have a slew of standout component grades, including top 17% for safety, top 14% of all stocks for growth, top 13% for sentiment, which is what the smart smart money thanks to the stock. Top 12% for financial strength, and momentum is the most impressive in the top 4% of all stocks. The soft spot here is value, but that even lands in the top 31% of all stocks, right? Top third. It's not a bargain, but certainly not expensive either. Nucor is riding a structural cost advantage in a time where American steel demand is surging. Add to it the stellar fundamental profile as proven by the Zen ratings, and you have the setup for a multi-year winner no matter where AI heads next. Before I get to that last pick, let me remind you that this coming Monday at 7 p.m. Eastern Time, we have my live training session. This is where I share my updated stock market outlook and trade of the week, which combines the power of the Zen ratings with my greater than 40 years of investing experience. It's completely free, but you do need to register. Just go to WallStreetZen.com/live or click the link in the description or scan the QR code on the screen, wherever it is, and we'll see you on Monday for more insights and top picks. Okay, the last stock might be the most surprising of all, and I'm talking about Levi Strauss with the symbol LEVI. All right, here we have an iconic 170-year-old blue jeans company. I know, it's not exactly the kind of stock that gets your heart racing, but hang in there for a minute while I spell out the special investment story unfolding now. When I first saw this one land at the top of the Zen Rings model, I had the same reaction you probably did right now, like, who cares? But as I dug deeper, it turns out that Levi's in the middle of a genuine reinvention. For most of its history, they made money by having other retail sell their products. Now, pretty much any store you went to, there was Levi's. Now they're selling straight to you through their own website and their own shops. You all know how it goes. When you cut out the middleman, you keep more of every sale and more ownership of the relationship with the customer instead of running it out to all the other retailers. That shift is lifting their profit margins, and it's the same playbook that built some of the strongest consumer brands of over the decades. People talk about moats all the time. Brands are some of the most difficult moats to really contextualize, let alone quantify. You can't build the intangible ace in the sleeve they have overnight. You cannot manufacture 170 years of name recognition. When somebody wants a pair of blue jeans, Levi's is the name that comes to mind fast. In almost every country on the face of the earth, right? That kind of staying power, that kind of ubiquitousness is precisely what you want when the other speculative trades such as AI might be unwinding. Now, let me show you how that staying power is real and concrete, not just a buzzword. Take a look at their earnings history. No need to strain your eyes. That's a lot of rows to count, so I'm just going to tell you. That's 20 quarters of earnings beats in a row. A full 5 years of operational excellence, right? You don't build a streak like that without attracting Wall Street's attention. So right now, 5 analysts covering Levi, all of them are pounding the table with buy and strong buy recommendations. Even better, the street high fair value price targets implies over 40% upside potential in the coming year. Now, the Zen ratings are totally aligned with this bullish view held by Wall Street. Once again, we have another elite A-rated stock thanks to being the top 1% of all companies given the complete 115 fundamental factor review. That fundamental strength is well-rounded as we drill down to the component grades. Here again, top 12% of all stocks for growth, top 11% for safety, top 8% for sentiment, which is focused on the smart money and insider buying activity. And finally, the standout is top 7% for financial strength, which means they are a top-notch operator. The most unique part of the investing profile is getting safety to go alongside that consistent growth. Very nice to snap that up when markets become volatile. Now, the thing to watch out for here is the state of the consumer. Levi sells a discretionary product, and if shoppers tighten their belts in a downturn, then jeans and other clothing are the kind of easy purchases you can delay. But really, none of that changes the bigger picture. This is a brand that has survived recession, world war, and more than a century of changing fashion trends. It was compounding gains for investors long before AI existed, and it will be here long after the hype fades. That's the whole point of the stocks in the list today. So here's the bottom line. You don't have to predict whether the AI bubble pops next month or next year. You just have to own the businesses that win no matter how things turn out on the technology front. And if you want to learn how to find more investment opportunities like this on your own, then don't forget about my live training session on Monday that I mentioned earlier. Now I want to hear from you guys. Which of these stocks do you think is the best play right now? And what are your thoughts on AI stocks and the likelihood of a bubble forming? Let me know down in the comment section below. And if you think there's a stock that deserves to be on this list I didn't cover, then don't hesitate to share it with our community. I also want to point you guys in the direction of another recent video. AI is the big story now, but quantum computing could very well be the next big growth trend. In the video that's popping up on your screen right now, I broke down the 3 quantum stocks I currently have my eye on. If that sounds interesting, then go ahead and give it a watch.